Something I think about, especially recently with the massive amounts of debt, in the world. I'm talking about how there's like 3 times more debt to GDP or something like that, roughly. How do you have more debt than GDP and expect anybody to survive that? And I think about before Lindsey Williams' friend died, his elite friend Ken Fromm told him the name of the game was debt. Lindsey, we're going to get the whole world in debt. Everybody's going to be in debt. We're going to let the markets get pumped back up. We're going to pull every last sucker back in before we pull the plug on that. The name of the game was debt. Get everybody in debt. So not only is everyone, as in people, in debt, but as you of course know, so are countries, financial institutions, and everyone's cooking their books, right? So while we think they look okay, nothing to brag about, just okay, they're actually far worse off because they've been cooking their books. Again, accounting gimmicks, accounting tricks. Do you remember a little company in the 1990s called Enron? Talk about the mother of all accounting gimmicks. Absolute nonsense. So we're going to indebt the whole world to where when the collapse comes, we are all in the same boat and we all have a very, very quick meeting. Heads of states everywhere will get together. In my opinion, this is how it's going to go down. You're going to get together and come up with a solution. And again, the solution that will be pushed is we need a one world financial system. We can't keep doing this currency thing. I mean, look at Venezuela's currency. Look what happened in the Weimar Republic. Look what happened in Zimbabwe. All these other countries. Brazil's in trouble. EU nations are in trouble. Guys, if we just had this one currency, we couldn't have currency wars and trade wars and all these things, because trade wars and currency wars kind of go hand in hand to begin with, because if you have a currency that's able to be devalued, your trading, exporting, is going to look pretty for you, but not for the other countries. They want to export too, and they want to compete against you, so then they got to devalue their currency, right? So trade wars equals currency wars. But if things were going to be fixed, we would see less debt, and people and countries and institutions paying off debt, not getting more indebted. It's as if all these countries know the end is near. Why are we going to stop our debt binge now when we know how this ends? We don't dare tell anybody. We're going to pretend that we didn't see it coming. We didn't know, but we got to act fast so that we can fix this. And the fix is going to be one world currency. Even Donald Trump, I feel he'll be powerless to do anything about it. But this article I want to talk to you about is from wolfstreet.com. Don Wejones. A hot new bail-inable debt cooked up by financial engineers in France. Spain's 3 biggest banks, Banco Santander, BBVA, and Saxia Bank, have got off to a flying start this year, having issued $8.6 billion in new debt, 7 times the amount they sold during the same exact period last year. Let that number sink in. The number 7, there's 7. Not because of the number 7, just because it's 7 times. They didn't double it. We doubled our national debt in this country in 8 years, 10 to 20. It's not the same, but nonetheless, 8.6 billion euros in new debt issued by these banks, which is what? 7 times. How would you feel if your $20, roughly almost silver, went up 7 times to $210? And you were able to say, man, this last year it was $20, and boy, this year it's $210. Would that make you happy? Yes. But would it make you happy if you owed, let's put in a different analogy, $20,000 in debt? You had credit cards, and now a year later, 7 times that, you're $210,000 in debt. New credit card. You had to issue some new debt to yourself, right? That's not going to be making you feel good. What makes you feel good is when the profit side is 7 times. However, this video is not even kind of about profit. This is about a worldwide epidemic problem. Debt. Citizens are in debt. Banks are in debt. Financial institutions are in debt. Everyone's in debt. Why are they in so much debt? Because borrowing has been so cheap over the last few years, they put themselves in debt. And you can be rest assured, because I'm going to tell you a little secret. For example, my boss, the owner of the company I work for, he owns the building. It's his building. He got a mortgage on it years ago before I ever even started working there. So he owns the building, but naturally he had to get a mortgage. Business account, but nonetheless, a mortgage. And in the commercial side of things, I didn't know this until I found out about, talked to him one day about this. I did not know this. And this was years ago that I found out, by the way, but up until then I didn't know. Every 5 years you got to refinance. Every 5 years, there's no way around it. You do not get a 30-year mortgage on a commercial property. 5 years. And I'm thinking to myself, could you imagine 1980s, 6-7% interest, all of a sudden 12, 14, 16, 18% interest almost overnight. And you got that commercial business 5 years ago when it was 6-7%. And now all of a sudden you're staring 14, 15, 16% in the face. Sir, it's time to renew your commercial mortgage. What's my new payment going to be? We're not talking a house. We're talking a large building. So not a $200,000-$300,000 house, more like a few $1 million building, correct? Okay. Do you have any idea how insanely high your mortgage would go for doing nothing? You didn't do anything wrong. You've got AAA, 800 credit score. You are the man. But the benchmark rates are higher, sir. We can't do anything about it. Sorry. Which means what? You lose the building. You might own a tiny bit left on the building. You might own just a little bit left. But you're going to be making those payments on the full amount like you've been for so many years. And now your interest rate's going up. Now, naturally, you'd say, well, in that case, I want to finance what I owe, start over, a new one, if it's possible, and pay these outrageously high interest payments, but at least I'm only paying it on, $500,000 instead of $2.3 million. But debt is going to kill the world off. That's why it doesn't matter that Donald Trump is a go-getter, make America great again, corporate tax rate 20%. We still have a massive debt problem. Anyways, the last time they rolled out so much debt so quickly was in 2007, he says, the year that Spain's spectacular, and the rest of the world's, ours included, real estate bubble reached its climactic peak. Santander accounts for well over half of the new debt issued, with 5.12 billion euros of senior bonds, subordinate bonds, in a newfangled class of bail-inable debt. Whoa, what? What is this? With the name of senior non-preferred bonds, aka senior, junior, senior subordinated, or tier 3, that we covered in some detail just before Christmas. Investors, beware. This newfangled class of bail-inable debt was cooked up last year by French-based financial engineers in order to help France's 4 global systemically important banks, BNP Paribas, Crédit Agricole, Group BPCE, and one of my favorite banks recently, Société Générale, out of a serious quandary: how to satisfy pending European and global regulations demanding much larger capital and debt buffers without having to pay investors costly returns on the billions of euros of funds they lend them to do so. That's what makes senior non-preferred debt so ingenious. It pretends to be simultaneously one thing, senior, in order to keep the yield and the cost for the bank down, and another, junior, in order to qualify as bail-inable. Who would have thought? What it amounts to is a perfect scam for the big banks to bamboozle bondholders, usually institutional investors like our beaten-down pension funds, the retirement funds, into buying something with other people's money that doesn't yield nearly enough to compensate them for the risks they are taking. Put simply, if a bank is resolved, holders of these instruments could lose much or all of their money, similar to stockholders, according to Olivier Irison, Executive Chief Financial Officer at Groupe PBCE, France's second largest bank. He says it's a very good compromise for investors and banks. I'm sorry, does he represent the investors or the banks? Well, Executive Chief Financial Officer he works at the bank. Very good compromise for investors and banks, says a banker. Which means what? You know, kind of like the used car salesman. Oh, this car, beautiful engine. I think it was rebuilt a year ago. It's great. Get the car, freaking thing's burning oil, leaking oil on the ground. Well, who did he represent? Did he represent you, the buyer? No, you went to him. He's the car dealer. He works for the car dealership. Same thing. Never, ever, ever trust a banker. Remember Austin Powers? There's two things that scare me more than anything in the world. One of them, nuclear weapons. And what's the other one? The other what? The other thing that scares you? Connies. In my case, bankers. Judging by how they're selling, yield-starved investors seem to agree or willing to take the chance. After the new bonds were rubber-stamped by the Banque de France in mid-December, investors gobbled up $1.5 billion worth of Crédit Agricole's senior non-preferred 10-year bonds, despite only receiving about 45 basis points more than they would get on traditional senior debt, and about 65 basis points less than on subordinated. Societe Generale quickly followed CA's lead, issuing $3.5 billion of 5-year dollar-denominated notes. Investors lapped it up. During the same week, BNP Paribas sold $1 billion of bail-inable debt, a mere drop in the ocean compared to the $30 billion of senior non-preferred debt it hopes to raise by 2019. BPCE issued its first non-preferred deal in the second week of the year, a $1 billion 6-year trade that attracted $2.4 billion of orders. It then launched an even riskier samurai yen-denominated non-preferred trade, and most investors were not put off by the A- rating. Quote, 2017 will be the year of senior non-preferred, said Vincent Horo, head of financial institutions syndicate at Crédit Agricole. Europe's biggest banks certainly have a voracious appetite for new funds. The European Banking Authority recently estimated a €310 billion gap in all the region's banks, meeting their total loss-absorbing capital requirements before the 2019 deadline, and much of that gap is expected to be filled by senior non-preferred bonds. The European Commission had already endorsed the financial instrument. Rating agencies have also lent their approval, and the ECB can't wait to come up with a common framework at a union level, as in European Union level. However, the legislation permitting its issuance is currently only in place in France and is not expected to be passed elsewhere in Europe before the second half of 2017, at least, at the earliest. But certain banks have already jumped the gun, including Holland's. Hey, everybody, I'm from Holland. Isn't that weird? Including Holland's ING and Spain's Santander, both of which have begun issuing senior non-preferred bonds, despite the fact that their issuance has not been officially sanctioned by each bank's respective national regulator. Just do it anyways, don't worry about it. Even more ominous, Italy's fragile superbank UniCredit has also expressed an interest, though it will probably have to wait for Italy's banking crisis, of which it has a major part, to blow over, assuming it can, before joining the party. And a staggering volume of debt. Even by today's inflated standards, the volume of debt in the G-SIBs hope to issue in the next 2 years is staggering. Santander alone intends to issue between 43 billion euros and 57 billion euros in order to meet the capital requirements that are scheduled to come into effect for the world's 30 biggest banks on January 1st, 2019. And again, if most of this is bail-inable, what is a bail-in? That's when they take money from the depositors over a certain threshold, but apparently They'll take it no matter what, threshold or not. We want the money. If it's over that money, if it's over the threshold, like the FDIC insurance, you're approved for up to $250,000 if should a bad day occur in the bank. But when you have these kind of numbers being thrown around by the biggest banks, and I know at least in the United States, they can only go up to $500 billion of bailing out. In other words, the FDIC insurance, through an emergency, can go to the Treasury and say, I need the maximum, $500 billion. Is that enough to cover that kind of deposits in this country when there's trillions and trillions and trillions of deposits? Not a chance in hell. I wouldn't trust that banking system as far as you could throw it. FDIC, that's like insuring, having a few pennies to insure the whole country. That's what it amounts to. That's what their little DIF fund that the FDIC has, which is normally around $50 billion. That's our rainy day fund in case any banks fail, $50 billion. I'm sorry, how much money is in the banking system? Deposits? Oh, quite a few trillions of dollars. So you don't even have 1 trillion. No, not even close. But there's trillions in deposits, yes. You don't have a trillion, correct. 50 billion. So what's a tenth of a trillion? 100 billion. You don't even have that? No. Wow. So again, they're issuing these bonds, as they say. And what is a bond? Well, same thing as the Treasury, a Treasury bond. Congress need to borrow some money. Okay, Federal Reserve, 50 billions in bonds, please. Okay, got it. Good. We're going to sell it off in the market. Here's your $50 billion. Now we pay interest on the $50 billion. Okay, so we're paying interest on $50 billion. The banks are going to do the same thing. We're going to print up these bonds, kind of like a share, issue this debt. We're going to make payments to the bondholders. However, if anything goes sour and we need to pay those bondholders back, the money is bail-inable. The money we have here is bail-inable to pay back some of those bondholders. Again, it depends on, what kind of senior, junior, all this nonsense, whatever, bonds. They're issuing debt to raise more money. The banks are issuing debt to raise more money so that they can meet the regulatory requirement. In other words, we can't get any more money in our banks, no matter how bad we try. So we have to issue debt, bonds, to get the extra money. And what sucker class is going to do that for us? Our buddies who run the hedge funds. Because they ain't making any money. They're not making 8% interest anymore for their retirees' pensions. They're not going to have any choice. They will have no choice but to put their money over here if they want any kind of return. And like I said, the banker, we feel it's a good compromise. It's a little bit risky, but it's a good compromise. You can bet it is. Because at the end of the day, the people will lose. And certain people will have their money taken out of their bank account because you're over the insurable amount. And this bank needed to be bailed in because they issued $50 billion worth of crap a couple years ago. And they're not doing so well today. And the average person who that happens to is not even going to have the slightest idea of anything that had even happened in the last 2 years, much less a bail-in. And what is that? Because they were too much into nonsense. Facebook, TV, sports, living the American dream or maybe the European Union dream. Maybe they're fighting with some refugees in the EU. You never know. But they're going to know, and they're going to be pissed off when they see their bank account tapped. Something I didn't authorize that. Oh, yeah, you didn't. Your government did. They allowed it. And we came up with this new type of bond that allowed us to do this. So the bankers wrote the law, passed the law, regulations. Yep, we'll accept that. And then all the banks benefit until they lose, until they start crashing, until another economic downturn. Then we got to bail it in. So it doesn't fit. We don't want it to fail again. We bail it in. No, let's not break up the banks. Let's not break them up into small pieces so they're more stable and manageable. And let's not take away their ability to be massive investment banks and regular banks at the same time, which Glass-Steagall and whatnot used to handle until Bill Clinton helped get rid of that. No, let's not do that. Make a bank an actual bank. let's let them keep gambling, and they'll keep gambling, and then they'll lose, and then we'll bail them in. And the retirees, your pension just got cut. Why? They don't want to tell you because the investment, specifically what they were doing with they were gambling with your investment, and they made a bad bet. They don't want to say that. So it's just simply investments weren't as good as we had hoped. That's the letter you'll get from them in writing. But we weren't able to find any good investments that could return the yield, so we got a little bit more riskier to get some yield. The bet didn't pay off. But they're not going to tell you the bank was at fault anyways to begin with. They were gambling again with your money. Nope. Can't do that. Again, the name of the game is debt. Banks are in debt. Countries are in debt. All of us are in debt. You remember the days of a bank, a bank that's doing things right? You need a mortgage? Yeah, listen, we're going to need 20% down. You know, the old conventional loans. Oh, now it's 10% down. You can get away with 10% now. Oh, okay. And then HOA, what's the other one now? Not HOA, FHA. 3%, no percent. Remember the no percent loans? No, you don't need any money. Nope. You're approved, you got good credit, no problem. But you need to see if I have a job. Nope. Your credit says you've got a job, you're good. Well, that's not going to end. That's probably going to end real well. So banks don't require any money from you to lend you a mortgage these days. I mean, it's insane. And I don't think it's just because like they want to be able to get the loan out there. We need to do anything for a loan, anything to give a loan out, even if we don't have to take a down payment, just give them a loan. It's not just that because they want to make that profit. I know, because I'm doing these videos every day, and you know too, the people don't have the money to put down. The majority of people in America don't have any kind of real money to put down in a house these days. Barely anything. That's why, can you put 3% down? 2%, no percent, good, okay, fine. That's it. People don't have 20% to put down on a house. Why? Because a $250,000, $300,000 house, $400,000 house, 20%. People don't have that laying around. Again, they say, was it 50% or so of Americans don't even have a few $100s in their bank account, living paycheck to paycheck. Oh yeah, there's some. That's the kind of homeowner we want. Give a mortgage to. Their 1 week pay worth of default, bankruptcy. I mean, but again, the name of the game is debt. It doesn't matter. Just give them a new credit card. Just keep going. Just keep going. Again, bankruptcies are up. I just did the video the other day. Personal bankruptcies rising again. Business bankruptcies rising again. But Trump's going to save the day. This problem is so far beyond Trump. He can't save the day. Superman cannot save the day. It's beyond him. It's beyond one man. This is a systemic thing that's been going on for a couple hundred years at least. Like I said, they got all their people appointed positions. They're all over the IMF. They're on the Bank for International Settlements. Every central bank on the face of the earth. These are the club members. Put these people in there. When this all goes down, they're all going to come out and talk to their Congress and Parliament. We've got to do the one world currency. It's the only way. Okay. That's what I see. Take care.